below. But let's get into the first one of the week. But before we get into the first one, a little intro about myself. My name is Spencer Sue. I am a Bay Area real estate agent. Every week on either Wednesday, Thursday, or Friday, late afternoon, early evening, I go over the biggest headline articles of the week. So if there's anything that you want me to cover or me to share my thoughts on, feel free to leave in the comments below, but I will be curating what most people are bringing up and what they are asking me. In the last 5 years, I've personally helped over 250 people with their moves in the Bay. So we do a lot. We see a lot. We're able to help a lot of people just like you. So if you want to go over a strategy call, let's get that set up today. Contact details are below. Let's talk about the whole thing about insurance. So make no mistake, home insurance in California has been in discussion for over a year now. And a lot of the big carriers have exited, not continued to exit. They've already exited. There hasn't been too many new ones that have been exiting, but for a while, the existing insurance policy holders were able to still get their renewals, but that is changing for specific areas. So take a look at this article. Thousands of homeowners in this wealthy Bay Area city are set to lose insurance. No good options. Where is a wealthier areas that are a little bit more in the hills? Orinda. The talk of the town in Orinda. This small affluent city nestled on the eastern side of the wooded Berkeley Hills in Contra Costa County has now been impacted. There's a lot of people that are not able to get a renewal of their rates in terms of the coverage. Now, this is the renewal of what has been, quite frankly, pretty darn affordable for the level of risk that was in that area. So in the past, you could get insurance. I think they had some numbers here. You can get insurance for like $2,000 a year. But now that has significantly went higher. Right. So the idea about the things there, let me see that. Pays about for that. So before he would be paying $4,000 a year for a place like at State Farm, but now he'll lose that. So now if he joins the FAIR plan, which is a California state plan that will give you a coverage along with adding a blanket kind of wraparound policy with it, you're looking at $10,000 plus. Now, I have helped the client buy an arena not long ago, and that is basically what you're going to have to factor in. So the key is a few things, and how will this impact things? Number one, for those that are living there, right? Now, on one end, a lot of people that own these homes for a long time, their cost basis is so low because one, they may not have a mortgage. Two, if they had a mortgage, they're able to lock in a really low rates. Three, their property tax is so low because of the proposition cap as to how much it can increase each year. So in general, their cost basis is low. So you mainly have a combination of utilities and you have a combination of insurance. But now that their insurance is significantly higher, the question is, will it break the bank of some of these people? Obviously, it's not good. Like they don't want to pay the extra $7,000 a year if they don't need to. But does that really make we'll see. I mean, that's hard to say. The reality is the median price, to give you an idea, in Orinda right now is $2 million. So on one end, it's not good for those that have lived there. On the other end, to be fair, this is kind of one of the things I wanted to bring up. Did it really impact much of the buyer pool of buying in that city? On one end, you can kind of say not too much. I mean, for the buyer, it is significantly more for them to factor in, right? If you think about $10,000 a year, that's equivalent to an extra $900 a month. If you think about payments wise, what is that? Extra 900. I think that's maybe $100,000 or so of payments. So it does definitely impact things, but because the area is so good for a lot of reasons, right? For the people moving from San Francisco, they want their own place. For many places that have pretty good views, for excellent schools, for privacy, for that charm, small town feel charm. Right? There's still a lot of big reasons why people live there. It doesn't help, but it hasn't actually impacted that negatively in the sense like people don't want to buy it. Now, I do have some clients that are considering places that are in the hills. So before you even consider it, are you okay with the potential of that $10,000 a year insurance policy, which is mainly going to be through the California State Fair Plan? And if so, then yes, you're welcome to look at these places, look at Berkeley Hills, look at Claremont, kind of the places in that region. If not, then you may elect to not choose those type of places, and then you're going to have to move more where there's flatter ground, more the suburb areas where the cost isn't nearly the same. So, but this is all something you can already get an estimate for beforehand. So here's kind of give you an idea of like these are the big players out there. So number one, in the past, you had State Farm. State Farm is still the biggest today. They just don't offer any new policies since last year, but they still have 8.7% market share. They will keep trimming down the places that they say consider high risk, and they'll quite frankly keep increasing the rates of those existing ones. You can see the rates have increased by 20% during that within a year. Farmers on occasion does some. So they have basically quotas. So I have a contact at Farmers that can do this, but they have like quotas, as in they can only do a certain amount each month. So this really impacts if you're able to lock it in the beginning of a month or at the end of a month. You really want to talk to somebody if Farmers is the company for you. So take a look. New policies have been capped at $7,000 per month. So that's that. Berkshire Hathaway Group. They have a very large provider. I think even Geico does home insurance. I think Geico's home insurance then goes through some of their offerings, I believe. But they have an option. So they're at 6.5%. They didn't make any comment, but I think they still offer policies. Allstate's a pretty big one, but they stopped offering. They actually were one of the earlier ones that to not offer, just to kind of cut back on that. So that you can want to take a look at that. Liberty Mutual insured about 4.4%, including home insurance through a Safeco insurance. Safeco has been doing a lot of insurance for a good amount, but I think even then, some areas they just won't write anymore. But they're still in general writing, but you can check and see of their own website whether they will offer or renew policies or not. So as you can see, a lot of them, and there's many others that are there. There's many others to consider, but either way, the idea is you really want to shop of your options and really understand your cost structure first. And I would say this is kind of the same process that you want to do in the very, very beginning, right? So rather than as part of deciding the areas that you want to focus on, think about it, right? You think about schools, you think about prices, you think about what you can get for your money there, you think about commute. Another variable now is more and more meaningful is think about, do you have an option for insurance? Because if you cannot get insurance, you cannot just buy the house unless you're buying it all cash. Every lender will require you to have an insurance policy. And so you really need to understand, are you okay with these numbers? From what I've seen, the most expensive ones are going to be through the state fair plan. And then they'll have a wrap policy with another provider. That's usually like $2,000-$3,000. But total is about like $10,000 to $12,000 a year. So you can factor that in accordingly and decide if that will work for you or not. But those are the things you definitely got to figure out first, because the last thing you want to do is, let's say you fall in love with a Rinda because it's all those things that I brought up. The last thing you want to do is be like, oh, wow, I didn't know insurance was going to be this amount a year. You know what? I will just skip it altogether. Well, if that was the case, there's no reason for you to have considered that area, right? It's just like, for example, people that consider living in Dublin. Dublin is a fantastic area, but the commute is far. So if you knew the commute was bad by simply just putting it into Google Maps and that was too unbearable for you, you shouldn't have looked there to begin with. Like, why did you even waste any time touring houses there? So same idea. You really want to understand up front. You can, as you can see, there's plenty of sites, there's plenty of platforms out there that will kind of give you a guidance. If you don't know, just ask me, and I'm happy to connect you with people that do. There's also the big players that are helpful here are insurance brokers. They generally have a wide variety, so they're pretty busy, especially as a lot of companies like the State Farm that doesn't write anymore. I don't even know what the point of them. Like it sucks to be a State Farm salesperson when you can't even write any policies. So, but that is what it is, and we may see things continue to be this way unless things can change on the state level, because the state level actually can provide some level of the reason why they're not offering is not because they just can't. It's because from how they do the calculations relative to, because mainly is the replacement cost is very high. It just doesn't make sense for them to keep doing it. So they're kind of trimming down things. You see this happening across Florida in a much more major way than here, but that's why you see the results of what you're seeing happening right now. But if the state says, look, we're going to allow the free market, or we're going to put a much bigger cap of the premium jump that these companies can do, then they may come back. They have their own internal calculations. They may also be very specific by zip codes. Like, quite frankly, there's definitely different risks. There's no reason why someone like myself that's living in like the suburbs in a very like without much hills around us, why we're paying the same amount or anywhere close to the same amount for those that are in the hills. Those are the things just to factor and be mindful of. Next, I want to talk about this because look at the way that they've described it. Home buyers turn to riskier adjustable rate mortgages. Is it really riskier? I really want to talk about this. As mortgage rates, so let's just talk about the history of it. As mortgage rates remain above 7%, some would-be home buyers are looking for another option to help them buy an adjustable rate mortgage. Instead of a fixed rate mortgage where you're locked into a rate for the duration of your mortgage, an adjustable rate one is one that can change as overall rates move, which means your monthly payment could go down over time, but can also go up. These buying houses tend to be doing this more. Average fixed mortgage stands at 7.29%. The average adjustable rate is 6.6%. And that's kind of it about this. So when you read this, you're going to be like, yeah, that sounds kind of risky. Are we going back to 2008 again? Because for anyone that had owned back in 2008, they had some variations of these adjustable rate mortgage products, except it was much more, it was way worse than this because it would fluctuate potentially yearly. It would also fluctuate, like people shouldn't have been able to get mortgages to begin with. But this is not that risky, depending on your situation, depending on what your future bet would be. Because the way that these adjustable rate mortgages work is that you have a minimum time that is locked, right? So there's a minimum amount. And generally, the minimum is 5 years. So you can go a 5-year, so they call it a 5-1 arm. 5 years down the road is locked. And then at year 6 or after the 5th year, you can then choose to, or it will then adjust to whatever that rate would be, but there may be some bands as to how much it can increase. There's also what they call a 7-1 arm. So that would lock it for 7 years. I think they even have a 10-1 arm, locks it for 10 years, and then it gets reassessed. Now, is it really that risky? It depends on your bet. Are you betting or are you thinking that over 5 or 7 years or 10 years that the rates will not be lower than it is today? Now, while rates are higher, we're not at all-time record highs, by the way. We've been in a band for the last 18 months between 6.1% to 7.6%. Right now, on average, we're looking at 7.1%. So it's been fluctuating for the last 18 months. There's no signs in the immediate future that we're going to have any rate cuts. Inflation is still hot. The market is still doing very well. The stock market is at all-time records. House prices have increased because of the stock market. So there's not a lot of signs that things have been cooling down significantly enough to have a rate cut, right? It doesn't mean that we're going to have rate hikes, but we're not having too much of the prospect of rate cuts anytime soon. So that's part of the reason why, like, if people are banking on that, they're not really being successful. But it's still the message goes to it. In the next 5-7 years, will it be lower than it is today? And most people are hopeful of that. Most people are even banking on that. And most people may be correct. Because the thing is this, you don't have to be perfect in terms of timing, right? This is not, you're stuck you're not stuck for 5 years. You've locked it for 5 years. So if rates go up, you're fine. If rates go down to a meaningful amount, usually a meaningful amount may be 0.5 to 0.75% off of what you have today, you can always refinance. And you can refinance to a different product if you want. You can refinance to a 30-year fix. You can refinance to a adjustable rate mortgage again, which then restarts the whole clock. So for example, if year 4 comes around and the rates are at, if you look at the adjustable rate today, let's say 6.6, let's say it goes to 6%, you may then refinance, but then do another 5-1 or 7-1, which is re-extends and restarts the clock, right? So that is an option that you can do. So it's really not that risky unless the rates do not drop. I mean, even if the rates are the same as the 5-year rate or the adjustable rate is still fine. It's only if the rates go up over time and they stay up, right? If they go up and down, that's kind of okay. You have some opportunities to refinance. But if it goes up and it stays up, then that's the problem of that. And then you'll be buying at whatever that rate may be. But ideally, to be fair, there is still a cap as to how much it can increase. You always want to look at your own loan product if you go with this. But at the same time, hopefully you've been accumulating capital anyways. And so every percent increase is the equivalent of a 1% purchasing power, at least from a math perspective. And so hopefully you've been saving up money during that time. You can maybe choose to sell at that time. There's some options when it comes down to that path. but it's not nearly as risky. It's not nearly as risky. Now, is it riskier to a 30-year fix? Of course, right? 30-year fix, you lock that down completely. But there is a risk of the 30-year fix, by the way, that people didn't factor before. Because the adjustable rate mortgage is lower, right? It's always going to be lower than 30-year fix. The spread will be different. Sometimes I've never seen the spread this big, so I don't think this is accurate at all. The spreads are usually much, much less. They're usually like only by a 0.1, 0.2%. So it's not 0.5% spreads. I've never seen it like this. But the idea is if there are small spreads, if the rate stays the same levels for extended period of time and you don't refinance, it's actually better to have done the adjustable rate one because you've been paying a lower interest rate all that time, right? So the 30-year gives you the stability, but if the rates have been relatively flat for an extended amount of time, it actually would have been better to do that. So that's just one aspect of it. But there's always a trade-off when it comes to having stability or potentially actually paying a little bit less. Now, the last thing I want to bring up is this little city here. This is the Bay Area's last affordable area. I mean, this is affordable. Here's what it is like to live there. Bay Point's value rose from an estimated $428,000 in March 2020 to $541,000 in March 2024, nearly a 27% increase. That increase, to be fair, you may be asking, how is that compared to other things? Let's do that momentarily so you can see for yourself, like how has that performed in the general markets. Let me pull this for you. In general, you can see this. They have another stat here. In SF Metro area increased about 19%. So it has done well. Take a look at these cheaper areas, right? All of these areas have actually done well. Antioch, Bay Point, Pittsburgh. It's all in that region, in the northern parts of Contra Costa County. Now, the interesting part in that area, they're still continuing to do some developments there, right? So there's still actually a good amount of developments that are still happening in that region when it comes to new homes, when it comes to mainly new homes, especially the Antioch area, the Antioch and the Brentwood area. They actually have quite a bit of newer homes being built out there. But how does this compare actually to the general S&P, right? So when you actually compare to the general S&P and you go from 2020, whatever time, let's just use the highest point, the S&P has still done better, right, in general than even some of the better ones. And that's generally the case, right? The S&P has gone about 50% since March of 2020 versus this time period. But it has been a very favorable place for those that have been willing to do the commute. Now, there is some things about this. So when you are in an unincorporated part about a city, because actually if you look at the Bay Area and look at Santa Clara County, you look at San Mateo County, there's actually many areas that are in unincorporated areas. So if you think about San Jose, what is a very prime area that's actually unincorporated? There's an area called Burbank, as an example. Burbank is right in between downtown San Jose. Then you have Burbank, and then you have Valley Fair. That area, you can buy a single-family home for $1 million. They're smaller homes. They're on the unincorporated zone, but they have that. So what do you really miss out on an unincorporated zone? Your tax basis is actually lower because you're not having to pay for basically city services, right? So you actually are not paying, you're not basically incorporated the city. So there's some slight changes. So for example, if you need to call the police department, that's different. You're not calling their local police department. You're calling you're basically calling the sheriff because it's on the county level. When you're trying to file for permits, that's not on the city level either. That would be on the county level, right? So there are certain areas like this where there's a long history of it, but the idea is they're generally the cheaper homes for many areas. There's some areas that are actually even more expensive, but for many areas are the cheaper of the homes. And so it's been an area where people say, look, I have X dollars to spend. I want to be able to buy a whatever it is, condo, single family, or whatever it may be. And I'm okay with the commute. Where are my options? And then they look around and they go from there. To give you some perspective, let me just do some math for you. So if you were to buy a $541,000 home, how much money do you need to make to be able to afford such a thing? If you're watching this live, please leave in the chat. Give me your thoughts. How much do you think it would be to be able to afford such a place? In terms of monthly, and then in terms of income from that. Monthly wise, let's just do some math. Here's a calculator. Let's say you put, in this case, 10% down. Right? Let's say you put 10% down. So basically you need to be able to afford $55,000 down. You need to be able to afford equivalent about $42.65 a month in terms of your expenses. And this will include everything. This will include your homeowner's insurance, includes your property taxes, includes your mortgage payments. So if I look at that, the income that you need from a lender perspective, gross, is at $113,000. A lot of people have seen what is the median salaries for different areas. $113,000 is not bad. There's a lot of people that can be single income that can afford this. Certainly can afford this. There are many people that are dual income that put their money together to be able to buy this, right? Because this is equivalent to, if you were a dual income with a partner, that's equivalent to what, $60,000 a year, equivalent to like $30 an hour. And given like our minimum wage now is like $20 an hour, it's not that far from it. So as you can see, when there's a will, there is a way, and there are options today, right? So these should give you a pretty good idea as to how people are making it work. The commute is long, it is bad, but it does give people the options, and that's the key. And maybe this is your starter home, maybe this works for you, but for those that are in this pricing category and they feel like they're stuck forever renting, I did want to paint this for you because not everybody is in this. Not everybody's in the position to be able to afford the median price, but this gives you a picture that I found it very, very interesting. Okay, if you have any questions or you want to talk about the Bay Area real estate market, or if you want to go over a game plan, just call or text me 408-547-4590. We'll go over a specific game plan depending on where your budget is, whether it's a starter home, whether you're first time getting out of rent, whether it's a trade up. We got 2 listings on the market this week. I'll leave it in the description below, and come join our open houses. One's listed at 1.7, one's listed at 1.6, both in San Jose. Drop by, send your friends. See you in the next one. Bye now.